for all of us, that would be good.
Yeah, my question is to the panel. Regarding the US Fed interest rate increase, what's your outlook and what's the impact on the investment? That's the first question. And second one, Glenn Stevens did mention that we're in a new paradigm where growth rate is going to be a lot lower than what we had in the last 20 years. And again, what's the impact on the market and so on?
Thanks for the question. So Carl might talk about the US interest rate, possible increase there. So the first question. Okay. I think the first question basically is, will the US increase interest rates this year? If so, when? What impact would that have on the market? Is that, yeah, that's correct.
I've got this chart here which shows US employment growth over the last 15 years, and on the right hand side there, that's the labour market conditions indicator. It basically derived from one indicator such as the number of people employed, full-time, part-time, the participation rate, hiring plans, etc. Now you've had fantastic employment growth in the US. We've got very, very low inflation in the US, and so prima facie everything's going really well. Low inflation, low unemployment, therefore you should increase interest rates. But I don't think they will. You've got the conditions indicators going back to negative again. We had last week US retail sales and inflation data also very, very weak, again suggesting that the Fed is unlikely to increase interest rates. Will they ever increase interest rates? It's been 10 years since they last increased interest rates. They probably eventually have to, but it may well be still a while before they do increase interest rates, which means that's actually good for stock markets, for the US stock market, for the Australian stock market, because it's just business as usual. Plenty of liquidity, and away we go again. The other thing I wanted to say, the longer though it takes for the US cash rates to go up, can I just go to slide 14? That's fine. Show one more slide. Slide 11. Can you please answer your second? What was the second question as well about the growth rates?
No, sorry. The impact of the increase. Every time there's a peak of an increase in market pressure.
Okay.
Are we,
Well, this chart shows you, if we start with Japan, you can see since 1979, where the chart starts, Japan has been above that red zone, and that red zone, according to this particular these economists, and it's been widely sort of agreed that above 250 to 275 debt as a percentage of GDP, once it gets above there, the weight of the debt on the economy is just so great. Growth is very sluggish. So you've actually seen Japan already for the last 25 years have such a high debt level that the economy has been really, really low growth, very sluggish. And you've had the the Japanese stock market at over 40,000 in 1987. Today it's 18,000. So in the last 28 years, the Japanese stock market is down over 50%. And I just think that the key determinant of that is this chart here, where we've seen debt levels just so high that an economy just can't function normally because you've got the interest cost. If you've got, just as an individual, in particular Australia, we've got very high property prices, So if you take out a huge mortgage when you're 30, you're just going to be spending a lot less on everything else while you pay off that mortgage. Now Australia, the yellow line, is creeping up a lot since 2011. And I think for Australia as well, we're well above that red zone. Well, all those countries above the red zone. And now we've got lower commodity prices as well. So growth will also be sluggish. I can give you a copy of the chart if you like. Or I can tell you the website where I got it from. So I think that answers that question, the second question as well.
Just sort of a counter view for that. I think because in terms of what might actually instantly happen if the RBA, if the Fed increases rates, it's all about what the market's expecting. I think the Fed's been guiding people pretty strongly to say, well, there is going to be a rate rise this year, and if something like 15 out of 17 Fed members have said they expect there to be, and they're the ones that make the decision. So they have been up, for the whole year, basically guiding the market to say there will be a rate rise, and so if they had actually raised rates at the last meeting, maybe it wouldn't have had that much impact because they'd sort of been telling people they would, but now the sort of the expectations are coming off a little bit, but still the whole market in the US knows that rates will have to rise there at some point, and there is a lot of speculation maybe when it does things will fall off, but it was a bit like when they were doing the quantitative easing and everyone was focused on that being reduced to zero and what was going to happen when there was no more quantitative easing, and then in the end nothing really happened because everyone was expecting that, and the market kept going and actually didn't have that big an impact. So potentially, the first few rate rises won't have too much of an impact because everyone's expecting it, and maybe it even gets up to 2% or something, and it doesn't have too much of an impact. I think if suddenly the market thought it was going to go up to 5%, given the debt they've got, that's when there'd be alarm bells and everything. But I don't think the first few rate rises in the US will have too much of an impact. There could be a little bit, but I think overall it's sort of being out.
I think the history says that the US stock market tends to rally around a rate rise, just like you're saying. So because if the Fed's raising rates, it sends a signal to the investors that they're worried about growth being too strong. So they're actually saying we've got to try and put the brakes on, but it's actually saying the economy's really strong. So it's sort of sending a strong signal. And what you can actually have going into that period is that if there's really bad economic data, the US share market could actually rally because they think there won't be a tightening, and conversely, good economic data could reduce the risk of a rate hike, and they'd promote the stock market further because of the cheaper money. So there could be very obscure effects going on around that rate hike. The other thing that's happening is that China unexpectedly depreciated the renminbi a couple of months ago, and I think that could have been very annoying for the Federal Reserve because they wanted to heighten rates, but with the China depreciating, it would push the US dollar up too much if they're increasing rates at the same time as China's devaluing, make the US dollar too strong. They don't want to they want to tighten rates, but they don't want to kill the US economy with a really strong exchange rate. It's already been too strong for them. So there are a few issues there.
I think the second question that you raised was around Reserve Bank comments about like a new normal, a lower growth rate being normal perhaps in the Australian economy, and also around, well, I'll just raise it myself, about Reserve Bank interest rates, where they might be going next with that. So I might ask Anthony to first respond to that.
Yeah, I just saw, we thought obviously it could have been a question to get about RBA interest rates, and actually saw some of these graphs just this morning came through from CBA on interest rate expectations, and because obviously everyone's been talking about where rates in Australia are going to go, and for the last probably 6 months the RBA's pretty much just had a neutral setting, so they haven't really been guiding the market one way or another. It's more been, we'll just look at the data when it comes through and see what needs to be done. But the market is slowly or gradually pricing in the prospect that there will be a rate cut, and so basically as at the moment, basically the market is pricing in 100% chance of a rate cut before February next year. And on the next slide, And then this is just showing how that's just changed over the past couple of weeks, potentially even in response to, Westpac increasing their mortgage rates. And if the banks follow suit, then people have been talking about all that. That gives the RBA even more impetus to cut interest rates there. And so this is showing what the market has priced in for interest rates going through over the next 12 months. And you can just see over the past 2 weeks. So 2 weeks ago it was the dark blue, now it's the light blue. So effectively it's almost 2 RBA rate cuts are now priced into the market. So that's the market saying, we think that the cash rate will be about 1.5% by around the middle of next year. And then the last slide showing then even the economists who are never always known for being right, their forecasts are also getting lower and lower. So the economists are starting to come in line to what the market is saying, that there will be a rate cut, within probably early next year. But it's just something we just have to wait and see. I think the RBA will still look at the data and see if they actually do need to before they press the button. But what could actually happen is, given the market's moving so far to saying, well, there definitely will be a cut, the RBA could start to change their terminology to say maybe definitely one way or another, whether there will be or there won't be, because they tend not to, they don't want to surprise the market too much. So if they think the market's really way out, then they might send a message to say that it is, or if the market's right, they then might send a message to say, well that's potentially we are on an easing bias again.
Anthony, if there is a rate cut in the first half of next year, is that going to create some friction, volatility with the banks, particularly with what Westpac have just done? You're creating, or what is going to be created is a larger margin between the cash rate and the bank rates.
Yeah, that's right. Well, I think there'd obviously be strong pressure on Westpac that they would have to move their rates down, but possibly what the other banks could use is the opportunity to not reduce theirs. And so you're right. Yeah, I mean, their margin. Obviously, Westpac thinks they need to have a higher margin, and so the other banks might do that as well. And yeah, there could be. Yeah, there's always sort of political argy-bargy about the government always wants the banks to pass the rate cuts on, but they don't always.
Sorry?
Oh.
Okay, I'll pose a question to Clarke if I can. Clarke, will the Asciano takeover still proceed given the ACCC's response?
Just to recap the offer was $9.15, including a 90 cents per special dividend and about $6 in cash. The share price before the offer was at $6.45 and is now currently about $7.65. Last week we saw the ACCC come out and say that they're concerned at basically the vertical integration of the two businesses of Brookfield and Asciano. Brookfield has track and port facilities, and Asciano with Pacific National has above track capacity. So it's a total vertical integration, and the ACCC has a strong preference for competition rather than regulation. Brookfield's offering certain guarantees in terms of conduct, but the ACCC, as I say, would prefer it not to rely on guarantees or regulation, but to have a competitive environment. And they've said that they'll make a final decision into December. So will they continue to block it, or will they back off? Just bear in mind that in 2009, the ACCC were very against Toll's takeover at Patrick, but eventually they backed off and didn't take it to the courts to force the issue. So I'd actually expect the ACCC to back off again, and they'll do that on the basis of guarantees from Brookfield in terms of performance, in terms of open access to ports, etc. And the impact will probably be that the takeover will be deferred until 2016. There is a shareholder vote due on the 10th of November. I expect that to be postponed. But just bear in mind where we're at the moment. The last 2 days you had an initial sell-off of the Asciano share price, down from about $8 down to about $7. And that sell-off was probably hedge funds taking profits and backing out. For the last 2 days the shares have been recovering. And I think the market's now, from the sobriety point of view, saying, well, we don't think the ACCC will block it. And also, what is the downside risk if they do block it? And take into account that it was 645 before and 765. The stock's trading at about 16 times FY17, about 4%, 3.5% fully franked dividend yield. It's not overly expensive, and it is the company does have quality assets. So if you do have Asciano, I'd probably actually add into your portfolio at the current share price. If you don't have it, I would buy a few. Because if the takeover goes through, you're going to do well. And as I say, I think most of the hedge funds have probably got out at this point in time. So the downside risk, there may be some, but there won't be as extreme number.
Thanks for that. Okay, another question for the whole panel, but maybe starting with Anthony. Following our last investment committee meeting, we recommended that clients increase their exposure to equities. Can you explain the reasons for this?
Carl wouldn't be recommending us to increase our exposure to equities, but he was overruled a little bit. So I think it really just goes back to that the first chart that Mark was talking about, and the market has come off quite substantially, and so you never really know if you're sort of at the bottom of these little cycles, but shares do look more attractively priced, and in particular the banks look pretty good value, and so we did think it was a good time to top up shares a little bit. So we're not, we didn't say put a huge amount into shares, because obviously there still are risks around China and the US and things. There's always risks around, but just the way, just the extent that the market had fallen, we thought that this was a good opportunity to top up shares a little bit more, given you don't get the market coming off sort of 15% very often. It sort of only happens every 2 or 3 years really. So it was a good time to increase that exposure and then hopefully benefit as the market comes back up again. Carl is going to tell us why we're wrong.
Nobody knows what's going to happen in the market, but one thing we do know is what the current levels of the market are and the valuations and where they have been historically. But so I do believe that they are overvalued, and I think that's almost fact, just like it's fact that property prices are overvalued. I mean, everyone agrees with that. It doesn't mean that they're going to go down. So for me, the question is not are they overvalued, but how long will they be overvalued, and will they just stay overvalued, and maybe eventually inflation and earnings growth comes through, and those debt issues over the long run disappear, or will we have a market correction? There are key risks. Well, let me start with the Australian stock market. It's fallen about 13% over the last 6 months. But to me, the key is going to be what happens globally and how resilient company earnings are. We've had earnings downgrades after the August reporting season. Plus, also the share prices fall, so PEs are about 15, 16. Not overly expensive, not overly cheap. But if earnings keep getting downgraded, and if we do have issues globally, we may end up having to go up simply because the earnings come off. And as I showed you just a moment ago, the debt levels in Australia are increasing, and that will be a weight for our GDP growth numbers going forward. But if I can just go to slide 7, I think the key is going to be what happens globally for Australia. So I've got 3 risks: China and the global economy. Will it slow further? Will the US increase its cash rate? as Anthony said, maybe it won't matter. But if they do increase the cash rate and people believe that all of a sudden the liquidity starts drying up, I think that can be a big issue. And also, we have creditor nations like China continue to buy US bonds. So US is able to, and it's a bit arrogant, I think, of the US. They keep having these huge budget deficits, huge current account deficits, and the creditor nations just buy their debt, and the US dollar goes up. But at some point, if the debt gets too high, you may end up having the US not being able to finance these huge debt levels. This chart 7 shows the US market and the corporate profit margin. Each time, with the exception of 1985, each time that profit margin has fallen by 0.6%, which it has now in the last 6 months, it has coincided with or predicted a US recession. On top of that, because we've had such low interest rates, corporate profits are actually artificially boosted at the moment because we've basically got zero cash rates over there. And there are expectations that earnings per share on the S&P 500 will decline for the second straight quarter. And that's the first time that will happen since 2009. So we're in the reporting season at the moment. We're having the Q3 numbers come out this week and next, and a few came out last week. We go to slide 8. This is the market cap of the US market relative to the gross value added from the US national account. So it's a very broad measure of how expensive or cheap the market is. That red line there is the average. So as you can see, we had the market was quite cheap in the 80s, and then we had the tech bubble, and Wushka went all the way up like that, and it came down a long way. Then we had 07, the GFC, or subprime in 07, the GFC 08, came back down, and now it's gone back up again. Now, even if corporate profit margin doesn't fall further, and that just reverts back to its mean, that's already a 40% decrease in the US market. Then if you get corporate profit margins falling as well, you get even a bigger decrease. Then if you normalise for the fact that interest rates are so low over there, and maybe corporate interest rates are just too low sustainably in the future, you get the earnings going down. So you can paint a really bearish picture by just normalising all these charts. So the US market could, in theory, fall 80% from its current level. I'm not saying that will happen, but if everything were to normalise, that's just a fact. Slide 9. This is a slide from Hong Kong Shanghai Bank. And they say here that in US dollar terms, the world economy is already in recession, or we've had 2 consecutive quarters now where global growth in US dollars is actually negative. And HSBC is saying that if you've got global growth deaccelerating, you've got the absence of what they call a policy put, which means that cash rates are zero already. You've had QE 1, 2 and 3. What is left over there? So what can they do if global growth keeps deaccelerating? You've got Bank of Japan, quantitative easing. You've got the ECB in Europe doing quantitative easing. The US, I suppose, can go to QE 4 possibly, but surely we're at the end of monetary policy. And on top of that, we've got valuations so expensive. So there's limited buffer there as well. So that's another example. This particular investment banker saying that, you know, wherever they look at the moment, they can't really see what's going to drive the market further. Slide 10. Okay, slide 10, probably my favourite chart for today. This chart looks back for 130 years, or sorry, 150 years in the US market. Every time there's been a recession, we've had PEs fall to single digits, with the exception of the last time. And it's the first time ever they introduced zero cash rates and quantitative easing. And all of a sudden, even though the economy wasn't that strong, the weight of money there pushed equity markets back up again. So the market at the moment, according to this analysis, based on long-term trend lines and looking at the PE, which is being smoothed for the last 10 years' earnings, so trying to smooth the PE as well, is about 77% above its long-term average. And at 24 times, I've got to 27 times PE on the S&P composite. So with the US falling, but it's all down to 24, it still looks quite expensive. Okay, I think that's all I wanted to say on that chart. I'll hand it back over to Nicole. Thank you.
Okay, we've just got time for one more question. So does anyone have a burning question? Yeah.
Thanks, Carl, for that. Assuming you are right, and the US stock market does fall 37%, how can we protect ourselves? What would you recommend we do? Because, I mean, every time there's a hint of a Fed increase, the market tanks. And every time there isn't one, the market rallies. So I think it's inevitable that the Fed will increase the rate. It's not, it's not an if, it's a when. So how can we protect our portfolio?
Okay. The way I've been doing it, and I've been coming here now for 3 years, and unfortunately when I first came here the market was at a bit of a low, and so the market had actually rallied in the last 3 years, although the last 2 years it hasn't. The last 5 years the Australian stock market has been about flat, and the last 10 years, as you know, the market's been negative. So I think it's been right to be cautious, maybe not exactly every particular period. So I've had my portfolios, probably for the last 10 years, what I call a barbell strategy. So I've had very high quality bonds, so not the CBA BB, not even the Macquarie HB, although I'm looking at that as I've discussed. So just the very short dated bonds, CBA, HA, they give you a lower yield, but they've got a solid, close maturity date. I've had private healthcare which matured recently. We've got a few maturing next year. The ANZ BA matures next year in December. That gives you almost 5%, and that's the Basel one. It's a very old one. Can't be converted to equity unless it goes under. They can defer the maturity date, but they can't convert you to equity. So then I've got nothing in the middle in the barbell strategy. No property, no big cap stocks, with the exception of like Medibank I spoke about last year. Well, I'm out of Medibank. And then I've got on the other end some of the more speculative ones that have done quite well. One didn't do well 4 years ago, but the rest have done quite well. And some of them have tripled, but I'm out of all them now. So I can't find another one. I'm quite fussy which ones I pick. They've got to be cheap and have earnings growth coming through, and with the market so expensive, it's very hard to find. So an example of what I did last week, coffee, COF is a code, announced a takeover. I looked at it with an analyst that night, and then very first thing before hopefully too many other people got wind of it, at 40 cents. Takeover's at 42.5, it's a done deal. That's 6.75% for 3 months. So that annualises above 20%. So you keep doing that. I'll do about 4 or 5 a year of those, maybe more, depending how certain I am of it, depending how well I know the stock, we put a big weighting in it. But because I have a lot of lower risk stocks, I can afford to put a bigger weighting in some of these plays, like the takeover ARBs. The IPOs, like Medibank, there's been a few higher quality IPOs. A few placements for accounts that are sophisticated investors, you can do that. And just grind a return, but you can still get double-digit returns doing that. That's what I've been doing, and that's what I'll do going forward, until either the debt thing resolves itself, or you get rampant inflation. Now, the US central bank and the central banks in Japan and Europe, they're trying to ignite inflation. They're now talking about helicopter money, QE4, monetarising their budget deficits, increasing their budget deficit, but monetarising it, and then as soon as they get inflation, putting it back straight away. But It's not that easy. It's like a huge ocean line. You just can't move it around that quickly. So I'm not sure how successful it's going to be. So I really think in the end game, there's only one solution, which is have a recession. That's how we've always had it. And we haven't had one for 25 years in Australia. I think we're a lot closer to the next one than the last one. That's probably stating the obvious, but and you know, equity markets and banks in particular, I mean, they don't perform very well in a recession. But I'm not always right, am I?